Hello, everybody. Welcome to History of Money. Professor Barth here, Arizona State University. Lecture number 37, The Post-Gold Era, Unanchored Capitalism and the Power of Big Finance. For lecture 36, we took a look at the Federal Reserve from the 1970s all the way up through 2020. For this lecture, what I would like to do is to survey the trends that have taken place in monetary financial markets and just economically across the board since 1971, okay, and attempt to draw a few conclusions out of that. The post-gold era begins after Nixon's closing of the gold window on August 15th, 1971. The link between the dollar and gold was certainly weak by 1971, but now it is completely severed. And since 1971, the U.S. has operated on a fiat standard, where the dollar is no longer backed by any commodity or tangible good, but solely by the good faith and credit of the United States government. Now, that hasn't stopped the U.S. dollar from remaining the world's reserve currency. And you look at this since the mid-1990s all the way up to, this goes to 2017, the U.S. dollar has comprised 60% of the world's reserve currencies. So the U.S. dollar is still the most demanded currency around the world. It has lost a lot of purchasing power, right? If you take 1945 as the standard year, a good that you could buy for $1 in 1945, now you need $14.47. That's quite a loss in purchasing power. But even if you just take it back to 1970, the final year that there was even a small link to gold yet remaining between for the dollar, $2.15 versus $14.47. So quite a drop. Here's quite a creative graphic. The purchasing power of the U.S. dollar since 1913, the year that the Federal Reserve Act was passed. And you see quite a huge drop there. What happened there? That was World War I. Then, during the early years of the Great Depression, there was actually some deflation. The purchasing power of the dollar rose. Money supply fell by about 1/3 in the early years of the Great Depression. And really, since the mid-1940s, it's been a gradual slide downward. And if you take a look at this graphic, this charts it from 1970. So from 1970, that's the trajectory of the dollar. Note that most of the loss took place in the 1970s. By 1980, the U.S. dollar contained only 40% of what it once did in 1970. But that's where we are today. Meanwhile, the price of gold has soared since 1971, when it was about $40 an ounce on the open market, $35 an ounce according to U.S. government. And today, it's flirting right up there with $2,000 an ounce. So that's quite a high price for gold, but there have been some dips. There was a dip after 2008 financial crisis. There's a dip after Paul Volcker's actions in the early 1980s. Are we going to see another dip, or will it continue to rise well beyond $2,000 an ounce? Only time will tell. And that leads me to this term, and it's one that I thought up yesterday morning. Actually, as I was thinking about this lecture and trying to, how do I describe this system, and I just came up in my own head this term, and I like it a lot. Unanchored capitalism, unanchored capitalism, and I think that describes fairly well the system post 1971, the post-gold era. And what do I mean by this? Unanchored capitalism is a variant of capitalism that places few to no restraints on the banking system's ability or capacity to create new currency and credit. gold operated as an anchor. Other countries with a silver standard, silver acted as an anchor. When you eliminate the anchor, now all of a sudden a banking system can create all of this new currency and credit at will. And the anchor, by the way, doesn't always have to be a commodity. It can also be a mathematical formula. That's what Milton Friedman proposed. But when you have unanchored capitalism and just this complete freedom for a banking system to create currency and credit, it has a tendency to produce and to encourage speculation, reckless behavior, a bloated financial sector, as we'll see here in a moment, and growing unnatural gaps in wealth and in income. I call this a variant of capitalism because capitalism is a very tricky term to define. It's very slippery because you have all sorts of different types of capitalisms. And one person, when they talk about capitalism, means one thing, another person will mean another thing. You have free market capitalism. You have more state-run forms of capitalism where a state plays a very, very active role in who's allowed to operate business. I would argue China is on somewhat of a state-run capitalistic system. You have corporate capitalism. You have more of a small business, entrepreneurial capitalism. And so you have all these different variants of capitalism. But for our purposes in this lecture, I'm talking about unanchored capitalism. And I believe the evidence bears out that in unanchored capitalism, there's a tendency toward riskier, more speculative investments, reckless behavior, especially within the financial sector, which tends to be more bloated under unanchored capitalism, as well as wider gaps in income. And this is made all the worse by the fact that our system then of unanchored capitalism combines with the moral hazard of too big to fail bailouts, of guaranteed bailouts where the profits are privatized and the losses are socialized, which, if you think about it, is completely antithetical to any free enterprise system. And this is why critics often describe this particular system of too big to fail moral hazard as a form of crony capitalism, where certain industries and certain companies get special favors, privileged favors that others do not receive. And this moral hazard from too big to fail bailouts incentivizes risk, incentivizes reckless behavior in a system, get this is the key, in a system that already operates without an anchor. All right? That's the key. That's the key. And what gets me and frustrates me oftentimes is a lot of people will look at the system that we operate in today and are very quick to generalize and to ascribe the negative consequences that arise from this, to ascribe those negative consequences to capitalism more generally, and in effect smearing alternative variants of capitalism that do not share those particular attributes. All right, it would be akin to applying a blanket judgment on socialism by analyzing the USSR. Okay, but that wouldn't be entirely fair to socialism because the USSR had one particular variant, but there are other variants of socialism also. Just to put my cards on a table, in my view, free enterprise is far and away the most effective system, and I think just historically it's just no contest. All right, no contest. That's my view. But this particular variant of capitalism I'm describing in this video, unanchored plus moral hazard too big to fail, has, in my judgment, levied significant damage on the U.S. economy. In the short term, it's alluring. You have a lot more credit. You have more consumption. You have booms, and during those booms, ordinary Americans can make a lot of money. But then you also have the big bust, and that's when many of the fat cats get bailed out, where the rest of the country is left hung to dry. and even during the boom, you still have sort of the top making more profits, as making a greater proportion of those profits than the rest of the country. And so that is the system I'm describing here. Let's take a look at a few charts here. And again, this is from the Federal Reserve economic data. This is total credit to the private non-financial sector. Look at this. Since the 1950s, as a percentage of GDP, personal debt in this country has just gone off the charts. So with the removal of the anchor, credit is much more prominent within the system, which can be good, but it can also be bad by burdening much of the population with unsustainable levels of debt. Look at this, and as a percentage of GDP, it was about 50%. Look at the peak here in 2008, 2009, 165, 170%. Went down a little bit in the 2010s, but not much. I mean, we're still at about 150% of GDP total credit to private non-financial sector. That's a lot of credit, and it's a result, I would argue, of this variant of capitalism, of unanchored capitalism. I also noted one feature of unanchored capitalism is a growing and arguably bloated financial sector. And if you take a look, this is a very long-term graph that is. The financial sector as a percentage of U.S. GDP goes all the way back to 1850, which is interesting to go that far back. But if we want to, take a look at the 20th century, since the mid-1940s, it's gone from about 2%, the financial sector, 2% of U.S. GDP, to over 8%. And that goes up to 2010. And that's about where it remains today, at hovering about 8%. So that's a quadrupling of the financial sector as a percentage of U.S. GDP. And if you take it since 1970, when the anchor, that final anchor, was removed, and keep in mind, the anchor in 1970 is a very, very weak anchor, okay? Very, very weak anchor by that point. Only foreign central banks can redeem dollars for gold, not people like you and I. And so, it's and the Fed was even abusing that by not honoring that $35 an ounce price. Nevertheless, it was a link. If you look at it from 1970, look at that. Gone from 4% to 8% by the mid-2000s. A doubling since 1970 as a percentage of U.S. GDP. This is another way to put it. So this begins in the late 1940s. Just a up, rise up. This data is from the Commerce Department. Then also take a look at this. Finance and manufacturing, share of all domestic corporate products. So in 1950, manufacturing comprised more than 50% of corporate products in the United States. More than 50%. The financial sector was just shy of 10%. So about 9%. 9% versus 55%. That's in 1950. And it remained close to that around 1970. Okay, 1970, about 45% of all corporate products come from manufacturing, and about 15% from the financial sector. Well, look what's happened since that time. Manufacturing has gone down. Finance has gone up to a point now where at the peak in 2004, toward the end of Greenspan's term as Fed chair, the financial sector took in 40% of corporate profits. And in 2012, it was close to 30%. That's quite a bit higher, quite a lot higher than what we saw in the post-World War II era. And manufacturing went into single digits by the early 2000s. I don't know what the current numbers are. But, and obviously there are other issues there, such as NAFTA, the rise of China as a manufacturing superpower. But this percentage of corporate products from the financial sector is quite a lot of growth. And then you take a look here. This is another way to put it. The line in the orange, U.S. financial profits, share of total economy profits, so a similar graph. And U.S. financials market cap share of the total market capitalization. So basically, if you take the value of all of the shares that are sold on the stock market, the financial sector takes in about 20%, which is a lot higher than the 5% the financial sector took in the early 1970s. One interesting note about unanchored capitalism, if you think about it, under the classical gold standard or under a classical silver standard, where does money originate? Say, well, in the mint. Yes, but where does a mint get its money? Oh, in the mines. Money originated in the mines. Okay? For better or worse, all right? That's where money originated. Under the greenback standard, as I'll call it, which is what we used during the Civil War, but also what colonial Americans used and what the Patriots used during the American Revolutionary War, where paper money, it's not backed by any commodity like gold or silver, but it's emitted from the U.S. Treasury, okay, from the Treasury Department. Under a greenback standard, money originates in the government, essentially, in the Treasury Department. But since the 20th century and into this 21st century, we live in an era now where money originates in the banking system. Now, under classical gold standard, you still had banks. Under the greenback standard, you still had banks, but the money didn't originate in the banks. The money made its way to the banks, in many cases, because depositors would deposit their money in the banks, and that's how the banks received that money. But here the money has its origin in the banking system, and that gives the banking system a leg up. It gives the banking system an advantage because it is the first one to have access to that money. And so that's another unique feature of this finance unanchored capitalism. Now, in 2010, Congress passed the Dodd-Frank bill in order to improve financial stability and in order to improve consumer protection. Opinion is mixed about how successful it was. It included more than 22,000 pages of regulations, including 200 new rules. So 22,000 pages of regulations, and this was in response to the financial crisis. Okay, we're going to finally regulate the banking industry. But in reality, the consequence of the Dodd-Frank Act was that it had the regulatory barriers fell most heavily on the small banks, on community banks. Here's the Washington Post from 2014. 4 years into Dodd-Frank, local banks say this is a year they'll feel the most impact. Lawmakers and regulators have spent the past 4 years drafting more than 200 new rules in an effort to clean up the financial industry. Now, as those measures begin to kick in, local bankers say they are bracing for the impact. And actually, between 2010 and 2015, the number of community banks in the United States, and a community bank is defined as a bank with less than $10 billion in assets, the number of community banks in the U.S. shrank by 14%, which was double the decline that we witnessed between 2006 and 2010, and many of those community banks were sold to the larger banks. Many of these smaller banks have been unable to bear the extra regulatory burden, whereas the big banks have enough capital and assets to be able to bear something like that. It's not as big of a deal, but for a smaller bank, it is a big deal. Many smaller banks have ended free checking. Many small banks have been forced to end services such as mortgages and car loans because in Dodd-Frank, borrowers can sue lenders for misjudging their ability to repay a loan. And so smaller lenders have exited the mortgage market because of increased risk. And so, intended or not intended, because you always have lobbyists in there who may intend some of these things, the effect of Dodd-Frank actually has caused many of the smaller banks to be wiped out by bigger multinational banks that now dominate the country. And if you look at the trends, this is a graph from the Federal Reserve, 5-bank asset concentration for the United States. So this is if you take the top 5 banks in the United States and then say, okay, what percentage of all banking, if you take all the banks, all banking assets in the U.S. and then take all the assets of the top 5 banks, what percentage do they comprise? Well, it's about 30%. Now it is above 45%. So just huge increases. Much of this increase happened in the 2000s. Dodd-Frank didn't do anything to stop it, and in fact, in some ways exacerbated the problem. Here's another chart. This is the top 10 bank holding companies as total when considering total share of banking assets. The top 10 own more than 60% of all of the total share of banking assets. The top 10 used to be just 35% back in the 80s. And now the bottom 90 banks, the smaller banks, the community banks, own just a quarter of banking assets when they used to be about half. And so the banking industry has become, in short, more consolidated in fewer and fewer companies. Now, as of June 2020 in the United States, there are 4,430 commercial banks and 636 savings institutions for assets that total $21.1 trillion. That's a lot of assets, $21.1 trillion. If you take the top 4 banks in the United States and total their assets, $10 trillion, or 47%. So the top 4 banks in the U.S. own 40%, or own almost 50% of the total assets in the banking system. The top 4 in a system that has basically 5,000 financial institutions. Who are those top 4? JPMorgan Chase, Bank of America, Citigroup, and Wells Fargo. Those are top 4. You want to expand it a bit to the top 5, which would throw Goldman Sachs in there. Then you're talking 11 trillion, 52%. And then if you do the top 7, which would include Goldman Sachs, Morgan Stanley, and U.S. Bancorp, then you're looking at 60%. 60%. The top 7 banks comprise 60% of all bank assets in the United States. That is just huge. So there's the top 4 banks. And these are the next 3. So the top 7 banks. And here's just a list of their assets as of the end of 2020. You look at them, JPMorgan, $3.1 trillion in assets. Here's their market capitalization, or the total of all their shares, $327 billion. It goes down the list. Number 7, U.S. Bancorp. Even though they're number 7, $542 billion in assets. I bank with MidFirst Bank, which is headquartered in Oklahoma City. They have a lot of branches here in Arizona. And I looked up, well, where's MidFirst? MidFirst, I was pretty proud, $28 billion. $28 billion. They actually don't have a market capitalization because they're a privately held company. Their stock is not publicly traded on the stock market exchanges. MidFirst was founded in 1981, but they are ranked at number 80. So I'm proud to bank with MidFirst. That's still a big bank. I mean, $28 billion. That's a lot of assets. So don't get me wrong. But nevertheless, you stack them up against these big boys, and yeah, looks like quite a small bank. MidFirst Bank is the official bank of ASU, so I had to throw in a little bit of a plug there. So these are the banks that U.S. clients are most likely to bank with. One of the things that I would encourage you, the viewer, to do is to not bank with these guys. You have options, believe it or not. You can bank with other banks. You don't have to bank with Chase, Bank of America, Citibank, U.S. Bank, or Wells Fargo. You can go somewhere else. You can go to MidFirst or any. There's so many others, like whoever, right? There are options out there. Exercise those options would be my advice. All right, so moving forward, I mentioned how another element of unanchored capitalism is growing gaps in income. Now, on the chart here, you see different categories: upper income, middle income, lower income. Upper income, according to this graph, which is provided by Pew Research, upper income are households that earn more than $120,000 a year. And these are in 2018 dollars, so it's constant, adjusted for inflation. Upper income more than $120,000. Middle income is between $40,000 and $120,000. So that's how these are defined. And then lower income is below $40,000. So you look at the group that has grown here. Upper income in 1970, so 1970s, the final year that there was a link to gold, upper income households had a share of only 29% of aggregate income in the U.S. Thank you. 29% of aggregate income in the U.S. Middle income households had a share of 62% of aggregate income in the United States. So, in short, stated differently, in 1970, middle income households owned considerably the majority of U.S. income. Now, in 2018, the latest numbers here in this chart, upper income households own 48% of aggregate income in the U.S., and middle income households own 43%. So it's gone down quite a lot. Okay? And then if you look at this chart here, this shows you what the median income is for each of the brackets. And the median income for the upper income families has increased the most since 1970. Middle income has also increased, but not as dramatically. Not as dramatically. Lower income has mostly remained the same. And then this is another interesting graph. Share of income earned by the top 1% since 1975. The United States is in the blue. Look at 1975. The top 1% of income earners in the country earned about 7.5% to 8% of aggregate income. By 2015, it's now up to about 17 to 18%. All right? That's a huge jump. Now, I don't want to be misunderstood here. I'm not against income inequality, actually. I know that's an unpopular thing to say, that you support income inequality. I support if someone works hard, has good ideas, and produces quality product and a quality service, especially if providers of that service or product are relatively scarce, that person should make more money. I fully 100% support that. I would no more support income equality than I would support grade book equality in my classroom. I teach, here at ASU. I don't have grade equality. I have some people who get A's, some people who get B's, some people who get C's, a smaller number who get D's, and then unfortunately 1 or 2 students usually every semester who fail. Okay, sometimes more than that. Eek. Well, so that's good. That's based on, that's all well and good. But if I were to notice as the years progressed that more and more students are getting C's, fewer and fewer students are getting B's, and then the number of students getting A's is shrinking. However, those students who are in that A bracket are getting like A+++++, that would raise some red flags. And like, wait a second, is there something unsound about my classroom? And I think what we're looking at here, unfortunately, the debate gets hijacked a bit by people who support income equality, and we need to level all incomes. And it gets and any talk about this issue becomes affiliated with that, and that's really a shame, because that's not necessarily the only position here. Another position is that, hey, look, income inequality is fine if it's based on actual, like, natural differences in work and in product. But what we've created, I would argue, in this system of unanchored capitalism is a system of unnatural income inequality in many cases. Now, again, to back up again, there are many people in the top income bracket today who earned it there, okay? Who earned that position. So this is not making this blanket statement about them. All it's saying is, I can look at a graph, okay? Not casting any judgment on anybody. I know some wealthy people who are the most charitable, like, good-hearted people I've ever known. Nothing wrong with owning wealth. Nothing wrong with it at all, if it's rooted in hard work and in quality product. But you can look at graphs here and you can observe trends. And there's a trend here, okay? And there's nothing wrong with pointing that out and saying, wait a second, what's causing that trend? All right. And I would argue that this system of unanchored capitalism is one of the culprits, okay? Now, moving to the second half of this lecture, I have on here a revolving door, because another element of our system is a revolving door between the financial industry and positions in government, okay? Let me give you a few examples. Let's take a look at the Treasury Department, beginning with Robert Rubin, who was Secretary of Treasury under William Jefferson Clinton. Robert Rubin, Treasury Secretary from 1995 to 1999. Before he became Treasury Secretary, he spent 26 years at Goldman Sachs and was co-chairman of Goldman Sachs from 1990 to 1992. After 1999, after his tenure as Treasury Secretary, he became Director and Senior Counselor of Citigroup, where he received more than $126 million in cash and stock during his tenure, up through Citigroup's bailout by the U.S. Treasury in 2008 and 2009. Moreover, Robert Rubin was chairman of the Council on Foreign Relations between 2007 and 2017. Robert Rubin's deputy, here he is, of course, with Alan Greenspan. There's Robert Rubin, Alan Greenspan, and Larry Summers. Larry Summers took over the Treasury Department in 1999. He was deputy under Robert Rubin. By the way, Summers with Rubin were instrumental in repealing Glass-Steagall, and both Robert Rubin and Larry Summers staunchly opposed any regulation of the derivatives markets. So these are, again, unanchored capitalism guys. Larry Summers was chief economist at the World Bank between 1991 and 1993. After his stint at the Treasury Department, he became a managing partner at a major hedge fund and a freelance speaker with Goldman Sachs, JPMorgan Chase, Citigroup, Merrill Lynch, and Lehman Brothers, where he accrued a total of $2.8 million in speaking fees. He is under Bill Clinton. So, quite a guy. That's a lot of work with those big banks. In 2009, President Obama appointed Larry Summers, not without controversy, appointed him director of the White House National Economic Council, and he served in that capacity through the end of 2010. Okay, whoa, who else? Who else do we have here? Oh, Hank Paulson. Hank Paulson, also known as Henry Paulson. Henry Paulson was Secretary of Treasury under George W. Bush from 2006 to 2009. Before that, he had worked at Goldman Sachs since 1974. Goldman Sachs since 1974, and get this, was CEO of Goldman Sachs from 1999 to 2006. Upon becoming Treasury Secretary, he was required to liquidate all of his stock holdings in Goldman Sachs because of a conflict of interest, perhaps, you think, and so he did. And his liquidations of Goldman stock were valued at over $600 million. Moreover, that sale of stock that he was compelled to do, $600 million, was not subject to any capital gains tax, which saved him about $50 million. Hank Paulson, of course, was Treasury Secretary when the TARP bailout was passed, in which Goldman Sachs got some money. Goldman wasn't the only one. AIG got money, JPMorgan Chase, all the big banks got a lot of money in that bailout. There's Hank Paulson before Congress. Then Timothy Geithner, appointed by President Obama in 2009 to be Treasury Secretary. Timothy Geithner worked under Robert Rubin and Larry Summers in the Treasury Department during the Clinton administration. He became a major senior fellow at the Council on Foreign Relations, and then in 2003 became president of the Federal Reserve Bank of New York. So the New York Fed president from 2003 to 2009. The New York Fed, of course, oversees regulation of Wall Street, but the president of the New York Fed is selected by the board of directors, which consists of members, directors nominated and appointed by the big banks in New York. As president of the New York Fed, Timothy Geithner was on record dining regularly with senior executives from Citigroup, Goldman Sachs, Morgan Stanley. He dined regularly with Jamie Dimon, who was on the Federal Reserve Board of Directors in New York, while he was also CEO of JPMorgan Chase. CEO of JPMorgan Chase, he's still CEO of JPMorgan Chase, but he became CEO in 2006, and then in 2008 began a 5-year tenure while CEO of JPMorgan Chase as a director for the New York Fed. Since 2014, after Geithner left the Treasury Department, he has served as president and managing director of a private equity firm in New York City called Warburg Pincus. Then we have the Treasury Secretary under Donald Trump, Steve Mnuchin. And Steve Mnuchin, who's been Treasury Secretary since 2017, joined Goldman Sachs in 1985, where his father was a major executive, and worked at Goldman Sachs for 17 years, after which he worked for and founded several hedge funds. Now, just to be clear, all right, like the comment I made about wealth, it's not bad having wealth. Hey, look, it's not bad being a banker, okay? Not necessarily. It's not inherently bad having wealth, obviously. It's not inherently bad being in the financial industry. We need banks. We need finance, okay? The question is, when it becomes such a revolving door, you have to wonder what's going on here exactly. These men aren't necessarily bad people. I don't know Steve Mnuchin. He might be a very good guy and may actually want good for the country. I'm not sure. But again, you can look at trends and look at that revolving door and ask yourself, okay, what's going on here, right? I can look at who's occupying these different positions, and at a certain point, you have to wonder how much influence is too much influence when you talk about the financial industry and government, because there's a whole lot of influence if you're talking about the financial sector and government. One of the ways that the financial sector exercises influence is through think tanks. And this is very underappreciated. Most people don't really pay any attention at all to think tanks. But think tanks are research institutions that perform advocacy on particular points of public policy. And different think tanks focus on different things. You have the Heritage Foundation, you have the Rand Corporation. But usually a think tank will publish articles, publish studies, make media appearances, pushing whatever public policy objective they desire to push. Drafting legislation, that's also a big role of many of these think tanks, working closely with congressmen to draft legislation. Usually receive most of their donations from private groups and usually millionaire, billionaire classes. The top two think tanks in this country are the Brookings Institution and the Council on Foreign Relations. The Brookings Institution has a budget of $100 million, annual budget of $100 million. The CFR has an annual budget of $80 million. And then you take a look at those two think tanks, which have a huge impact on public policy and more than you would think, shaping public opinion, but definitely exercising influence within the halls of Congress. Former chairs of the CFR have included sitting board members of JPMorgan Chase, Goldman Sachs, and Citigroup. The current chair of the CFR is David Rubenstein, co-founder and CEO of the Carlyle Group, which is a multinational equity investment company, and Rubin has a net worth of $2.5 billion. Before David Rubenstein became the chair of the CFR chair for 10 years was Robert Rubin, the former Treasury Secretary under Bill Clinton. At the Brookings Institution, the current co-chair of the Brookings Institution is Glenn Hutchins, who's the co-founder of a $49 billion private equity firm. And the other co-chair, Suzanne Nora Johnson, is a former vice chair at Goldman Sachs, and she currently serves on the corporate boards of AIG, Visa, and Pfizer. Other trustees on the Brookings board include high-level execs at Deutsche Bank, Bancorp, Goldman, including the managing director of Goldman Sachs, as well as other top financial firms. So, in think tanks also. And these think tanks, Brookings Institute, CFR, whether they support Democrats or Republicans, there's a consensus. And that Washington consensus is free trade, globalism, economic consolidation, reducing regulations on financials and securities and investment companies, reducing regulations on multinational corporations. This is called the Washington Consensus, and has really existed since the end of World War II. Then you take a look at the Securities and Exchange Commission. The Securities and Exchange Commission was established by FDR in June of 1934, and it was tasked with regulating the stock market and trying to limit speculative transactions. And it will investigate things like fraud and insider trading. Well, historically, the SEC has been shown to act quite consistently in the interest of Wall Street banks and hedge funds, and will selectively bring charges and for fraud and insider trading while not pursuing charges in other cases. And then, additionally, a report from the Project on Government Oversight found that between 2006 and 2010, 219 former SEC employees represented financial clients before the SEC. Okay, got that? So between 2006 and 2010, 219 former SEC employees, people who formerly worked at the SEC, 219 former SEC employees represented financial clients before the SEC. Moreover, even though the SEC is required by law to keep files for 25 years, during and around the 2008 financial crisis, the SEC destroyed documents relating to inquiries that they had made into Goldman Sachs, Lehman Brothers, Citigroup, Bank of America, and other major firms. Employees and directors at the SEC have previously been employed by firms such as JPMorgan and hedge funds. For example, the chairman of the SEC from 1993 to 2001 was a man named Arthur Levitt. He later served, after his term at the SEC, as a policy advisor to Goldman Sachs. And since 2001 has been a senior advisor at the Carlyle Group, a multinational private equity and financial services corporation. Robert Khuzami, between 2002 and 2009, worked as a general counsel at Deutsche Bank, which is a global investment firm which does a lot of business with Goldman Sachs. But in 2009, he was appointed director at the SEC for Division of Enforcement. So the director of the Division of Enforcement at the SEC in 2009 was a man who, for 7 years, did a lot of business with Goldman Sachs. So, revolving door. And again, you can't just by default say corruption, right? By default. But you can't also by default just brush it aside and say nothing to see here, move along, okay? Obviously there's something here, okay? And it's a product, again, I would argue, of our system of unanchored capitalism, this bloated financial sector. Well, to conclude, what about elections? Because the financial industry exercises a lot of control over campaign finance and is involved quite heavily with campaign finance. Let's take a look at a few examples. They don't always succeed, as we will see. In 2008, Barack Obama versus John McCain. Obama outraised John McCain by a ratio of about 2-1 among the big banks. And this is from opensecrets.org, which is part of the Center for Responsive Politics. And I'll just go through a few charts here. These are securities and investment firms. And you'll see the breakdown here. It's for the entire cycle, so you'll see some primary candidates who didn't make it, Hillary Clinton. But there's Barack Obama. This is in 2008. Commercial banks, Barack Obama outraises McCain. Private equity investment firms, Obama outraises McCain. Hedge funds, finance and credit companies, venture capital, and then miscellaneous finance companies that don't quite fall under one or the other. Barack Obama significantly outraises John McCain. Now, in 2012, interestingly, the banks go to the Republican side, and Romney vastly outraised Obama among the financial sector. Securities investment. Look at that. Mitt Romney raised $26.5 million. Obama just over $8 million. Commercial banks. Wow, look at that. Romney just killed Obama among donations from commercial banks. Private equity and investment firms. That's not even close. Barack Obama did not have the support of the financial sector in the 2012 election. Hedge funds, finance credit companies, venture capital, miscellaneous finance. Obama won that election. So, just because the banks support a candidate doesn't mean that candidate wins. Another example, 2016. In 2016, Hillary Clinton outraised Trump by more than 10 to 1. By more than 10 to 1 among the big six banks. Hillary, she got her, had quite a lot of support there from the big banks. Let's see, 10 to 1, wow. Banks spent record amounts on lobbying during the 2016 election. And you look at this, securities investment. Trump didn't even beat Jeb Bush. Jeb Bush outraised Trump among securities and investment. Look at Clinton, over 12 million. Commercial banks. There's Trump, number 3. Jeb Bush, still number 2. Guess the banks like Jeb. Private equity and investment firms. Hillary Clinton, easily. Trump is 3rd place. Hedge funds. Trump's 5th place. Finance and credit companies. Well, Trump made it to number 2 for that one. Venture capital. Trump is number 4. So Hillary just took over, and of course still lost that election. Then in the most recent election, the banks pretty overwhelmingly sided with Joe Biden. In fact, Joe Biden received quadruple the amount of donations than Trump from individuals affiliated with the top 8 banks. Biden had a significant fundraising advantage with individuals from JPMorgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley. Wall Street is shunning Trump. Campaign donations to Biden are 5 times larger. So you'll see here, securities and investment. Look at that. Wow. No contest. Joe Biden, $13.5 million. Trump, $2.7 million. Trump barely beat Pete Buttigieg at $2 million. Commercial banks. Biden significantly outraised Trump. There's Buttigieg again. Private equity investment firms. Whoa, Buttigieg was number 2. Donald Trump, number 3. This is in 2020. Joe Biden among hedge funds. Donald Trump, 108. Finance credit companies. Venture capital. Man, what was it about Pete Buttigieg? The banks really like Pete Buttigieg. Well, he was a corporate-friendly neoliberal, so I guess he would have been quite friendly for banking interests. But there is Joe Biden, Pete Buttigieg, Donald Trump, and then miscellaneous finance. Trump did a little better there, just over $4 million, but still outraised by Joe Biden. So, and again, it doesn't mean just because the bank supports somebody, they're the bad candidate. That's not how it works, okay? But it is interesting to get a look into that window and see who is finance supporting in this election. And finance doesn't always get its way, all right? Finance also sometimes does get its way. So, you watch this video, you may be wondering, man, there's a lot of info. The banks, you may agree, have a lot of power. Finance is this huge industry. What do I do about it? And I mentioned this earlier in the video, but I think that there are 2 practical things you can do. Again, I'll repeat myself. Don't bank with these guys. You don't need to bank with these top banks, okay? There are many other banks in your local community or your local region, many of them which are still big banks that have several billion dollars of assets, but are nowhere close to the big 5 or the big 6. And exercise that option. Go somewhere else. And then the other piece of practical advice I would give you, use cash. Use cash. We're more and more becoming a cashless society, but I'm persuaded that cash is very important to hold on to. And why is that? Well, cash originates in the banking system. It's true. Nevertheless, once you have cash, it's outside of the banking system now. And so you have some independence from the banking system when you're using cash as opposed to your debit card or your credit card. This is something that you own now, and it's money that you can spend without having any other intermediary getting their hands in it. Also, cash is a way to avoid surveillance systems, okay? It is anonymous. It can be spent without having any sort of tracking associated with it. So, while Andrew Jackson would be quite furious to know that his visage is on the front of a central bank note, nevertheless, I think Andrew Jackson would agree that, hey, use my bills, right? Use this $20 note as opposed to just relying on that piece of plastic. The banking system and surveillance systems would rather you use that plastic. Try using cash, and I think that is another way that you can practically resist this this behemoth, this financial behemoth. Anyway, all right, I'll end things there. Hope you enjoyed this lecture. I know there was some a lot of opinion laced in there, and I also understand that many of the viewers may disagree with some of the things I had to say, and that's okay. We live in a free country. This is just how I see it. Okay, this is how I see it, and but I hope that you learned something from this presentation. Very good. I look forward to seeing you again. So long. Bye.